Desperate times and deflation call for desperate measures. The European Central Bank has announced today it will embark on a fully fledged quantitative easing program from March. Quantitative easing is often compared to printing money, and some economists and nations are opposed to the move, including Germany in the Eurozone itself. The ECB will make asset purchases of around 60 billion euros every month until the end of September 2016. Now that means an overall injection of more than 1 trillion euros. Now, this is why, in a nutshell, quantitative easing creates so-called easy money. The central bank buys bonds which are offered by countries or institutions that want to borrow money. These institutions and governments then have more scope to lend out the cash to invest or spend. Ultimately, consumers are able to get money on credit more easily and spend more as well. So quantitative easing boosts cash flow and spending with the aim of boosting companies and growth. It's the very same measure that the United States is now withdrawing. But the US economy is on the mend while the Eurozone is facing deflation, where prices fall rather than rise, and it's trying to avoid a triple-dip recession. The stimulus in America helped to lift investments in emerging markets like our own, so the move may be good for South Africa in the long term. Well, ECB President Mario Draghi says they're hoping that prices in Europe will start to lift soon.
So current information and prevailing futures prices for oil, annual HICP inflation is expected to remain very low or negative in the months ahead. Such low inflation rates are unavoidable in the short term, given the recent very sharp fall in oil prices, and assuming that no significant correction will take place in the next few months. Supported by our monetary policy measures, the expected recovery in demand, and the assumption of a gradual increase in oil prices in the period ahead, inflation rates are expected to increase gradually later in 2015 and in 2016.
So lowering interest rates are another way to fire up the economy, but the European Central Bank decided to leave interest rates unchanged today, realizing that there's very little room for maneuver. The bank's refinancing rate has been at a historic low of just 0.05% since September. Let's take this further now. I'm joined by Mabianina Epiri from ACM Gold. Great to have you with us.
Thank you.
So I think I outlined the ideal where this puts a huge cash injection into the system. So the bank gives to other institutions, they can lend out more, everybody can spend more, go to the shops, companies have an incentive to manufacture more, the whole economy lifts up. But is that an ideal, or does that happen in theory? Because of course we have this model in America now.
Well, look, yeah, so like you've mentioned, the idea is that when you provide liquidity to banks and financial institutions, then they have more money to invest and subsequently boost the economy, whether it's through the creation of jobs and just to get spending going on in the economy. But what tends to happen very often is that you'll have all this cash injection into the systems, and instead of filtering into the real economy to boost the economy, you find that you get a lot of asset bubbles being created. So in other words, there's artificial demand, for instance, in the financial markets. We've seen, I believe that that's a similar case to what we saw in the United States. But I think the main difference in the United States is that it's one country governed by, in other words, you're not taking into consideration the different nations. I mean, the European Union is made up of 19 nations.
Does that make it much more complicated?
Definitely does. I mean, you've got different countries with different problems and different solutions that will be suitable to different countries. And now, as a central bank, there's little that you can do to sort of try and support and boost growth in all the nations within the union.
Explain those concerns again. So the money basically goes to investors and stays with these investors that invest in stocks, say on the market and things like that. It doesn't go down to the ordinary man on the street, basically.
That's usually the case. So, for instance, if it depends on the channel in which this quantitative easing is going through. If they're buying bonds, then you find that prices of bonds start to rise, and hence you start to get that artificial demand. And everyone buys into bonds, and the prices climb until such a point where it's unsustainable. Then we have a correction in the market. And that tends not to, especially if you're printing money, it's inflationary. So by the time it filters out to the ordinary person, there's a lot of inflation. The value of that money is not the same as it was initially when introduced.
Is this fear of bubbles really correct, though, this fear of inflation? Because we don't see it in America. America is just starting to recover, and Europe is in deflation.
Well, look, that's part of the reason why the ECB actually finally decided to get the program going, is because there was pressure coming in terms of deflation. So a solution to deflation is printing money, which is inflationary. So that's also part of the reason. But I mean, if we look at the interest rate is very low, and they couldn't do that anymore. And I think the main issue is the demand and spending locally. Whereas in the focused on austerity measures and cutting labor costs in order to make exports more competitive, the main issue, or the underlying issues, are domestic. You've got people who...
So this is all they could do, basically. And I want to ask you, could it work? Despite the concerns, and could it help South Africa? Because Europe is our main trading bloc, so when they do well, our exporters do well. Could this be great for us?
Look, I mean, right now it's too early to tell. So it can be great for South Africa if it is in fact effective, and it does start to boost a little bit of growth in Europe. Like you've mentioned, we trade quite a lot with Europe, and there's also concern in terms of global growth. I mean, we only have America that's doing well. China is not doing so well, Japan not doing so well, and Japan also entered into this, and we haven't seen any significant growth in Japan as a result of QE. So there are positives if it does work, and we need it to work, because there's the global growth outlook has been revised, and I don't think America can carry the whole world. So if Europe does improve, then at least we start to see global growth going up, and subsequently we'll have commodity prices going up, and as a commodity producing nation, that would be a positive for us.
So it is a desperate measure. It may work. What about, I mean, our rand? I looked just in the last hour, it's been strengthening. And could this, down the line, as was predicted with US quantitative easing, help boost investments in emerging markets? Because there's all this cash floating around the global system, so it could help our market.
Look, I mean, yeah, there's always a filter through into emerging markets when such programs are introduced, but I think their main concern will be to boost growth domestically in their respective states. So definitely there is a positive that we could see filter through to South Africa, but I don't think that's the main concern. And if we're to see any growth in South Africa, I would say that we would have to focus on the challenges we have ourselves and try and foster growth as opposed to just
sort of
waiting for that cheap money to filter in.
Okay, you've alluded to this, and maybe we can go into it a little bit more. Europe is facing deflation, very low interest rates. They can't even lower it anymore. In the US, also low interest rates, but they're thinking of raising their interest rates, pulling back on all the stimulus, because their economy is basically standing on its own 2 feet. So we're seeing this huge divergence in the tools that these two groups are using.
Definitely. And I mean, one of the reasons why America is doing so well is that they were able to create jobs. I mean, in November, we saw about 321,000 jobs created, and they've sort of been consistent with that. So they're in a totally different situation from the Eurozone. Hence, a one-size-fits-all policy or what's applied in America doesn't necessarily mean that it's going to work in the Eurozone. So I think Europe really needs to concentrate and mainly, instead of focusing on austerity measures and cutting labor costs, I think they need to focus on what they produce, and focus on key sectors that would help boost growth.
Let's stay with interest rates. So we've brought up this graph, and you can see that in America and in the euro area, interest rates are basically at nil. These incredible lows, even negative in the US. Now, what does this mean for us? Because our interest rate is also pretty low, but compared to this, we look very attractive to investors, don't we?
Yeah, we do. I mean, we've got a totally different scenario because in South Africa, I mean, because of low oil prices and subdued prices in the oil price, we are, originally interest rates were supposed to, the Reserve Bank did indicate that we're in a phase of hiking interest rates. But now they have decided to see the effect that the oil prices is going to have, and then they will have a policy reaction to that. So we are a bit attractive, but we still have a lot of challenges. We've got Eskom, unemployment, and that's sort of also a very big concern for investors. Without power, it's very difficult to for businesses to operate in South Africa.
The interest rate, I mean, everybody's looking at the Reserve Bank's meeting next week. Do you think they could actually go down this year?
This year, I think they could go down, but I don't think it's going to happen anytime soon.
Rough ballpark? Before the end of the year, maybe, so second half kind of this year.
Definitely. I mean, if we do expect the U.S., the Federal Reserve to raise interest rates in the second half of the year, then I think there might be a policy stance by our Reserve Bank to sort of align with what's happening in the U.S. But I think there's quite a lot to consider before raising interest rates, and they would have to look at, like I've mentioned, the prices of oil and that and the effect that's going to have in the economy.
All right, thank you so much for your analysis. I think this is so complicated and it's so hard to make it simple. Yeah. But I get the general gist that we'll wait and see. But hopefully good for Europe and good for South Africa as well, the quantitative easing announced today. That was Mabianene Peri from ACM Gold.